We'll understand accounting treatment of acquired goodwill and its impairment testing. Judicial position. Can depreciation is allowable on goodwill? True Energy Services Private Limited versus DCIT Delhi High Court held that goodwill arising on acquisition is a depreciable asset under Section 32 subsection 1 subclause 2 of Income Tax Act. No separate evaluation of goodwill is required if purchase consideration exceeds the fair value of net assets. The excess is treated as goodwill and depreciation is allowable. Point 2. Slump sale and goodwill. A slump sale refers to transfer of an undertaking as a going concern for lump sum consideration without asset-wise valuation. Here is important is the asset-wise valuation. There is no asset-wise valuation in case of slump sale. We are paying a lump sum basis and we are transferring undertaking as a going concern. It naturally gives rise to goodwill since one consolidated price is paid. The excess paid over book or fair value of assets and liabilities is known as goodwill. Third, acquired goodwill meaning and formula. Definition: premium paid for intangible benefit that can't be individually recognized. That example, brand customer synergy. Formula: goodwill is equal to purchase price paid minus net fair value of assets and liabilities acquired. Example, purchase price is equal to 100 crore, net assets fair value 80 crores, then goodwill will be 20 crores because 100 minus asset taken over 80 crores, so goodwill will be recorded at 20 crores. Then how will treat in Income Tax Act? What will the tax treatment of that goodwill? Section 32, subsection 1, surplus 2, depreciation is allowable on intangible assets, including goodwill. Section 43, subsection 1 says that actual goodwill, actual cost is equal to consideration paid. A's objection of lack of separate valuation rejected by courts. Hence, acquired goodwill is depreciable even without independent valuation. So it is important. Acquired goodwill is depreciable even without independent valuation. The index. What is the accounting treatment as per the index? First, you will see the recognition. Index 103 business combination. Goodwill arises when purchase consideration plus non-controlling interest plus fair value previously held interest minus net asset fair value. It is known as goodwill. It is recognized as an intangible asset. Measurement. Initial measurement. Goodwill is recorded at cost. It is very important. Goodwill is recognized as at cost. That means the excess consideration paid. If you go to previous, we have paid 100 crores and asset we have taken over 80 crores. Excess we paid 20 crores. This is known as the goodwill. And in subsequent measurement, unlike Index 14, it will not amortize. Instead, it will go for the annual impairment testing under Index 36. It is very much important that in subsequent measurement, the goodwill will undergo the impairment testing each year. Allocation. Goodwill is allocated to cash generating units, which is known as CGUs, or group of CGUs expected to benefit from the acquisition. CGUs is known as smallest units generating largely independent cash flows. The important point note to that independent cash flows. Allocation must be completed within the year of acquisition. It is also worth noting that allocation must be completed within a year of acquisition, that identification of CGUs must be completed in the year of acquisition so that in case of subsequent measurement in the next year, we can go for the impairment testing based on the synergy we are getting from the CGU. Then we come to the impairment testing. Compare CGU carrying amount including goodwill versus recoverable amount, higher of value in use or fair value less cost to sales. Point to note here that carrying amount. The carrying amount means the amount appearing in the books. Carrying amount. Recoverable amount is important. Why? Because it is the higher of value in use and fair value less cost to sell. If carrying value is greater than recoverable value, then there is impairment loss. Loss first reduce goodwill, then charge to profit and loss account. And it is very much to note that once goodwill impaired can't be reversed. So no reversal permitted for a goodwill impaired. Now we'll understand the what is the expected synergies. Justification for goodwill. Synergy will come in various types like revenue synergy, cost synergy, operational synergy, financial synergy, and strategic synergy. So what is revenue synergy? That new customers cross-selling brand leverage. What is cost synergy? Economic of sales, elimination of duplicate functions. What is operational synergy? Tech integrations, research and development, acceleration. Financial synergies, lower cost of capital, tax benefit. Strategic synergies, entry into new markets, access to license or resources. Numerical example that synergy and goodwill. Suppose A acquires B for rupees 450 crores. Net assets fair value of B is equal to 400 crore. The goodwill will be 50 crore. Combined value with synergy is equal to 1,100 crore versus standalone A 600 plus B 400 is equal to 1,000 crore. The synergy value is equal to 100 crore. Buyer pays part of synergy upfront, 50 crore goodwill, expecting to realize balance later. Key takeaway. Tax view. Goodwill, even from slump sale, depreciable under section 32, subsection 1, subclause 2. Accounting view index. Goodwill is equal to excess paid, not amortized, but subject to annual impairment testing at CGU level. Business logic. Goodwill is goodwill is the price of synergies and intangibles expected from acquisition. Thank you. You can get the presentation from the download itself. Thank you.